The president says the jobs report is great. What he described, it's an early Christmas present, a Christmas gift for the president and arguably to the country. And it's not the only economic gift on his tree. Here we have the tree up and running. A stock market that is booming, even though the pace of trade negotiations has faltered. The major indices are all within 1% of their all-time highs. And an economy that is growing faster than 2% a year. It's not the 3 or 4% the president had promised at the beginning, but it's better than the other leaders are getting in their stocking at the moment. Think about Europe, where you're barely lucky if you're talking about 1, and some of the cases like Germany verging on recession. So jobs, stocks, GDP. Diane Swonk is with me from Chicago, the chief economist at Grant Thornton. It's very difficult to see, what's going wrong in a sense. The US performing spectacularly economically at the moment.
Well, certainly this jobs report was great news, and we really welcome it. Even with the GM strike bounce back, as we said, the underlying jobs growth was over 200,000. I think that's very important. Another caveat, though, is that the manufacturing weakness, once you adjusted for the GM strike, that was still there. It was basically flat manufacturing activity from a year ago, and overtime hours actually fell, even though GM workers came back. But what's good about it is that it didn't spread into the service sector, where we're seeing all these job gains. We saw leisure and hospitality picked up, healthcare picked up, professional services stayed strong. Those are all really important because it means we're not seeing the contagion many people had feared from the manufacturing sector to the broader economy.
But people like you continually worry about the level of debt at all levels: consumer debt, corporate debt, leverage. This is going to be something that will, it may not affect today or tomorrow, but it's weighing on views and sentiment.
Well, what we are seeing, sentiment is higher in the month, but we are seeing that the U.S. economy, for as good as it's been and longest expansion forever, what it's not had in momentum, it has had in sustainability, and that sustainability is finally producing these lower unemployment rates. As you mentioned, 3% wage gains, that's great, but that's still a small fraction of what we were expecting if we would have ever gotten down to this kind of unemployment rate in the 1990s. We had much stronger wage gains in the 1990s and higher confidence in the 1990s boom, despite the fact that the economy had higher unemployment rates. So I think that's important as well. We're having all the wage gains are in entry-level jobs. That's terrific, but we're not seeing that trickle up into supervisor jobs that we'd like to see as well.
Are you convinced that we are in a new normal, or are we waiting for the old rules to come back and bite us?
I think there are some old rules that will come back and bite us. You mentioned debt. Corporate debt is at extremely high levels, and debt defaults have gone up. There's not a lot of room to redo it over again, even though the Fed is cut by 0.75%. There's not a lot of lower interest rates that companies that can't sustain that debt can refinance on. And so bankruptcies, we think, are going to go up over the next year, and during the next recession, hopefully not soon, but during the next recession, that could exacerbate the next recession, because we have a lot of what's you sort of almost term zombie companies out there, companies that were able to sustain themselves with these ultra low rates without a lot of revenue growth, and their margins have been compressed.
And those zombie companies, is there evidence that they are being weeded out? Or is the life support, well, thank you, you've just answered the question. And then what is the worry? What do you do with those zombie companies? Because eventually rates are going up. Now, it won't be in 2020, and it won't be significantly maybe until 2021, 22. But does that matter?
It does, actually, and it doesn't even matter if rates don't go up. If rates don't go down a lot further, and frankly, there's only a limit before zero, right? They're not going to be able to restructure their debt. And already we are starting to see, I wasn't completely honest, we are starting to see defaults pick up in the junk bond market, and the junk bond market is not quite as giving as it once was. Those are going to sort of start to tick away. I'd rather see those companies churn over now, and they're dragging down productivity growth in the U.S. as well. I'd rather see them sort of get restructured now when the economy is still strong, rather than have it all happen during a recession, because that would make the next recession deeper.